Hello everyone. In this video we will see the class 11 accountancy. The class 11 accountancy subject which is been segregated into two parts, part 1 and part 2. Part 1 and part 2. In the part 1 financial accounting we will see in this video the first chapter. The part 1, I would repeat once again, the part 1 financial accounting. In that we will see the first chapter, introduction to accounting. We will see that entire chapter today itself. In this video you will see the quick revision of the first chapter. In this we will see the first chapter, that is introduction to accounting. In this we will see the first chapter, a quick recap of introduction to accounting. So children, just tell me, what is an introduction to accounting? Introduction to accounting itself means, what is accounting? Accounting means nowadays it became an important tool in helping decision makers or in helping in decision making by the management, as it makes available, what it makes available? It makes available the required information. So accounting therefore or thus means an information system which provides you the accounting information or some information they are providing through accounting to the users. And who are the users? Internal users and external users. Users thereof to arrive at why they are providing an information, because thus to arrive at a proper decision. Decision maker will give the decision. So the students who are able to see my videos, you can able to learn the basics, as you don't need to call your parents or siblings or anyone, any elder one, as it's a quick recap. All the 16 chapters we will be including in the accounting. All the 16 chapters will be in kind of a quick recap in the form of videos, which will cover all the syllabus that will help you all to score good marks easily. Added to it, the students don't need to spend the extra time to prepare the accountancy subject. Okay, as I've made it crystal clear the entire notes. So today we will see only the first chapter. Today in this video we will be covering only the first chapter, introduction to accounting. Moreover, added to it the notes which I have prepared here for accountancy chapters, that is the chapter 1, it will be helpful for you. Just you need to revise and keep a glimpse of it. The main things like debtors, creditors, suppliers, stock, goods, these are all the main things, main terms of accounting which you need to use on your day-to-day basis, that is on your daily basis, as it will help you to prepare the entire syllabus throughout the year. Because if you just learn for on just exam point of view, it will not be going to help you. If you learn, only if keep in mind, only if you learn from heart and you will use the accountancy notes which are prepared for you on a daily basis or a day-to-day basis, it will be helpful for you to prepare your entire syllabus for this year, that is throughout the year. So moreover, you can do one thing, you can see the notes, you can prepare your notes by yourself, as well as you can take a quick recap of the notes which I have prepared for you. Just have a look of the notes. Also, I would be recommend you to just prepare the accountancy textbook. From the textbook to you just see a quick glance, then the notes which you will be having from your college plus the notes which I have prepared for you. These three will be a best tactic to score good marks. And moreover, needless to say that it is a worthwhile task, as all the data is managed into well-defined form, so that you can able to start from the simplest chapter to the toughest chapter or to the complicated chapter. From lesson 1 to lesson 16 we will be going to one by one. Okay, so that you will get more main concepts clear, that is the tough concepts you will get clear. Easy concepts anyone can make you clear, right? Tough concepts, tough concepts no one can make you clear unless and until you should be able to get the concentration, get the understanding what I am going to say or what the textbook is going to tell you. Yes, children. So this all will remind you and this all will help you to score good marks. So you need to revise it twice during the exams or thrice during the exams. So without wasting our time, we will just have a quick recall of the introduction to accounting. So shall we start? Now we will be seeing the chapter 1, introduction to accounting. The first introduction to accounting we have seen just now in our previous slide. The next comes the meaning of accounting. So see here, meaning of accounting. I am giving you a quick glance. Okay, quick glimpse I am giving you. See, meaning of accounting. So in the year 1941, listen carefully. In the year 1941, the American Institute of Certified Public Accountants is known as AICPA. AICPA. What they have defined is the accounting as the art of recording, classifying and summarizing in a significant manner and in terms of money, transactions and events which are in part at least of financial character and interpreting the results thereof. Okay, I will read once again. In the year 1941, the AICPA has defined accounting as the art of recording, classifying and summarizing in a significant manner and in terms of money, transactions and events which are in part at least of financial character and interpreting the results thereof. Okay, what they have mentioned and defined accounting as the one which we have just seen now. Next comes the American Accounting Association. American Accounting Association is a AAA. Okay, so in the year 1941, AICPA has defined accounting in some different manner. In the year 1966, AAA, that is American Accounting Association, they defined accounting in some different manner. We will see that too. They define that the process of accounting is the process of identifying, measuring and communicating economic information to permit informed judgments and decisions by users of information. Okay, I will read once again. The process of identifying, measuring and communicating economic information to permit informed judgments and decisions by users of information. So these both they have given their definition with regard to accounting. So what happened in conclusion, in the year 1970, the accounting principles main head of AICPA main board, they also emphasized and focused that the function of accounting is to provide quantitative information. Mainly their focus is to provide financial information, that is primarily the financial information in nature about economic entities that is intended to be useful in making economic decisions. So thus what happened? In the year 1970, AICPA's Accounting Principles Board have emphasized that the function of accounting is to provide quantitative information, that is financial information about economic entities that is intended to be useful in making economic decision. So in a quick recall, I would say students, mark this as important. In the year 1941, AICPA's definition with regard to accounting. Then comes the year 1966, AAA, that is American Accounting Information, that to mark it as important. The third, the year 1970, AICPA's Accounting Principles Board, mark that is also as important. So what they have defined with regard to accounting. So what is accounting all about? We will see that. Now what are the relevant aspects of the definition of accounting? Yeah, you can say what are the relevant aspects to definition of accounting. So accounting, what is accounting? Accounting can therefore be defined as the process of identifying, measuring, recording, communicating the required information relating to the economic events of an organization to the interesting users of such information. Those who need the information, what does accounting provide? They provide the quantitative information, financial information. How they provide? There is a process for it. First we will identify what's the issue, what's the problem. Then we will measure it. So measuring. Then we will record it. Recording and communicating the required information relating to the economic events of an organization to those who need, to the interesting users of such information. Then comes the relevant aspects to the definition of accounting. So there are 4 relevant aspects. In the meaning of accounting, you can see the image which is being given there. You can see there. You see there, accounting links have been given here. The process is first to accounting information, economic events, decision makers. Now who are the decision makers? Both internal decision makers as well as the external decision makers. So here they are showing the process of accounting, how accounting links actually work. Now see here the relevant aspects to definition. See, the first is economic events. Economic events. Economic events. So what is economic event? An economic event is known as a happening of any consequence to a business organization, which consists of maybe transactions or maybe something, and which are measurable in monetary terms. Okay, just economic events. See, economic events means an economic event which is known as a happening of any consequence to a business organization, which consists of transactions, and mainly which transactions? Monetary transactions, which are measurable in monetary transactions. The next comes is relevant aspect comes is identification, measuring. What is it? Identify, then measure, record and communicate. So identification, measurement, recording and communication. So what is that? Identification means, it means to determine what transactions to record, that is to identify events that are to be recorded. Okay, the events only we should identify which are to be recorded. Measurement means, it means the quantification. Like for example, including the estimates of business transactions into financial terms by using their monetary units. Recording. So what is recording? What you have seen in the identification and measurement, once the economic events is identified and measured in financial terms, these have been recorded in the books of accounts in monetary terms and in a sequence order. You can say in a chronological order. Okay. Then next comes the last comes in your communication. Like identify you have done, measuring also you have done. After identifying and measuring, you came to a recording. You came to a recording in the books of accounts in monetary terms and in a sequence. Then comes to communicate to the interesting users. So communication. So what a communication means? The economic events which are identified, measured and recorded in order that the pertinent information, that is the important and relevant information, is generated and communicated in a certain form to management as well as the other internal and external users. We will come back to the internal and external users. Who are they? Okay. The next comes, there are 4 relevant aspects. The first, economic events we have seen. Second is the identification, measurement, recording and communication we have just completed now. Next comes the organization. Next comes the organization. It refers to a business enterprise. It refers to a business enterprise, whether for a profit or not for profit motive. Any business. Organization means it refers to any business enterprise, whether it's for working for a profit or it's for working for a not for profit motive. Then the last relevant aspects with regard to accounting is interested user of information. Interested user of information means accounting, which means by which necessary financial information about any business enterprise is communicated and is also called the language of business. It's also called a language of business. So what others do? Many users need these financial information, these important financial information. Why they need? Because to make a proper decision, in order to make important decisions. Their decision should not get wrong, right? Otherwise, how the business will run? So that's why, see, interested users of information. That means accounting is a means. Accounting, what is accounting? It's a means. It's a way by which necessary financial information about business enterprise is communicated is communicated and is also called the language of business. So what these people do, many users need this financial information as this is very important and a priority for them in order to make a sound decision, in order to make an important and sound decision. Now we will see internal and external users. Users means they are segregated in two parts. We will see in our next slide. I'm just giving you a glimpse here. Internal means who? Internal means inside the company. As the name suggests, internal, inside the company. Who will be inside the company? The manager, the financial manager, the plant manager, the management, and so on. Like external means who will be the external? Those who are external, those government, public, then lenders, yes, lenders, creditors, investors. These are the external users. Okay, so internal and external users. I hope you are getting a clear information in that. Okay, in the next slide we will see now few more details with regard to introduction to accounting. See, relevant aspects of the definition of accounting. We have seen just now in our previous video. You can see here economic events, then identification, measurement, recording and communication. It's the second relevant aspect of definition of accounting. Then comes the organization. Organization means any organization, may it be for the motive will be for profit motive or not for profit motive. Then comes the interested user of information. So you can see here in the image the users. Who are the users? Internal users, external users. External users. Now see here internal users. Who are the internal users? Inside the company. Branch managers, plant managers, business unit manager, financial officer, chief executive, management. These are the internal users. The next comes the external users, present and potential investors. That is the investors who are now present investors, that is. Okay, and main investors who were now and who are now. Okay, present investors and potential investors, that is the major investors, main investors. Then creditors and lenders, tax authorities, regulatory agencies, employee and labor unions, government, public and so on are the external users. Now we will see the branches of accounting. So there are three branches. You can see in the image. So you can see in the screen. There are three branches of accounting. The first comes the financial accounting. So what is financial accounting? Financial accounting means financial information. It helps us in keeping a systematic record of financial transactions, the preparation and the presentation of financial reports. Why they help in? Because in order to arrive at a proper decision, arrive at a sound decision for the organizational success. Okay, so see, once again I will repeat you, financial accounting, there are three types of accounting. There are three branches. The first is the financial accounting. Second is cost accounting. Third comes the management accounting. Okay, so now see here, the first comes the financial accounting. Financial accounting means it assists in keeping a systematic record of financial transactions, like the preparation, the presentation of financial reports in order to arrive at a sound decision, at a financial sound decision for the organizational success. Now the next comes for cost accounting. So what is cost accounting? Cost itself means cost of various products, ascertaining the cost of various products. We will see what is cost accounting. Cost accounting helps us in analyzing the expenditure, how much the expenses is for ascertaining the cost of various products which are manufactured or services provided by the firm, and fixation of their prices thereof are called as cost accounting. Okay, so we will revise once again. Cost accounting. Cost accounting. What is cost accounting now? Cost accounting is nothing but it helps in analyzing the expenditure, for ascertaining the cost of various products which are manufactured. Either they are manufactured or the services are provided by the firm. They will find the cost of the various products. They will ascertain how much is the cost of the various products which have been produced or the services are been provided by the firm, and fix the prices thereof. That's called a cost accounting. The next and the last comes is management accounting in branches of accounting. Management accounting. So what is management accounting? Management itself means from the necessary accounting information they manage or they make, it will help them to make a sound decision. Okay, see, management accounting, it deals with the provisions of necessary accounting information within the organization. Remember this point, within the organization. What is management accounting? Management accounting deals with the provisions of, they will keep a provision of necessary accounting information to the people within the organization. Why they have given? Because to enable them in sound decision making. That is the decision making, planning and controlling business operations. Okay, now we will revise once again in a quick. Branches of accounting is divided into three parts. Financial accounting. Financial accounting means systematic record of financial transactions in order to arrive at a sound decision, financial sound decision for the organizational success. The next comes the cost accounting. Cost accounting is nothing but to ascertain the cost of various products which are being produced by the company or the services are provided by the company, and they fix the prices thereof. It's called a cost accounting. Next is the management accounting. So what is management accounting? Management accounting is nothing but they will keep a provision of necessary accounting information to the people within the organization. Why they keep? To enable them in decision making, planning as well as in controlling the business operations. The next comes is the, you can see the in the slide beside, qualitative characteristics of accounting information. Qualitative characteristics of accounting information. So what is qualitative characteristics? Characteristics means the features of the information of accounts. Okay, so what is qualitative? Qualitative means quantitative information you all know. So what is qualitative? Qualitative means reliability. They are reliability. Reliability means an accounting information should be objective and reliable. To be reliable means it should be free from any errors and bias, and it should represent what it should represent. It should be transparent. In short, it should be a transparent. Okay. So see, reliability. In the next slide, you will see a quick recall of this, the qualitative characteristics of accounting information in a diagrammatic manner. You just now understand and listen what I am trying to make you understand. Qualitative characteristics of accounting information. Okay, I would repeat once again. Qualitative characteristics. Which characteristics? Qualitative characteristics of accounting information. Now see, the first is reliability. Reliability means the accounting information should be objective and to the point. It should be reliable. To be reliable means it should be free from any errors and bias. Bias means partiality kind. It should be crystal clear. It should be transparent and it should represent what it should represent. Okay. Then next comes after reliability is relevance. Relevance means it should be, the information should be relevant for decision making. To be relevant means information must be made available in time. That is on time it should be made available and help in prediction and feedback. help in prediction and feedback for the information which is being provided. The next comes is the understandability. Next comes is the understandability. Understandability is nothing but the information which is being provided should be readily understandable by its user. It should be presented in simple terms and form. Like for an example, if an organization is given this task to some other person who is an outsider. So when he submits its report, it should be crystal clear, it should be reliable, and it should represent only what it should represent. The next comes the decision maker should be able to understand what is done. That is, it should be presented in a simple manner, simple terms and simple form, so that it's readily understandable who is using that report. Why it should be simple? Because to arrive at a sound decision. The next comes here comparability. Next and the last qualitative characteristic is comparability. Comparability is nothing but a comparison. Comparison you can say here, like an accounting information will be useful and it will be useful and beneficial to the different users only when different users, but only when it is comparable over the time and with other enterprises. It should be comparable over the time. It should be comparable with the other enterprises. I would repeat this once again. See, comparability. Comparability means it should compare. An accounting information will be useful and beneficial to the different users only when, understand here, only when it is comparable over the time and with other enterprises. For this, what they should do, there should be a consistency should be there. So what you will say, there should be a proper consistency should be there. That is, the use of a common unit of measurement should be there. The common format of reporting, it should be a common format. Then the accounting principles, the policies, the measurement, all should be common. That time only they can compare with one firm to the different enterprise. They can compare. Like comparability is nothing but an accounting information which can be compared. So how it can be compared? Only when they are having a consistency in the use of common unit of measurement, common format of reporting, and common accounting policies. So in our next slide, you can see the qualitative characteristics of accounting information in short, as well as the image description which will be there in a diagrammatic manner. Like qualitative characteristics of accounting information, who are the decision makers, what is understandability and all. Now we can see here in this slide the qualitative characteristics of accounting information. So reliability. Reliability means the information provided should be reliable. Should be what it should be represent, the same it should represent. Then relevance. Relevance means it's nothing but we have seen how relevant it should be for decision making, for a proper decision making. Then comes the understandability. Understandability means it should represent in a simple term and simple form. That is, it should be readily understandable by its user. The last comes is the comparability. It should be able to compare to the other enterprises in terms of everything, in terms of common unit of measurement, in terms of reporting, in terms of accounting policies. Provided they can compare, is they should have the common type of format. Common accounting policies, common format of reporting, and common unit of measurement. Now you can see here the diagrammatic manner of qualitative characteristic of accounting information. You can see here decision maker. Who is the decision maker? The users of accounting information. Like I said you an example, if an organization is given a task to someone who is outsider, so what he will do, he will present a report, he will do all the judgment and all, and he will just submit a report to the decision maker, to the main user of accounting information. So while representing the accounting information, it should be crystal clear, it should be relevant to the point, and it should be understandable, and it can be compared, so that one organization can compare its report with the other organization only when they have the common consistency, like common feedback should be there, common consistency should be there, common reporting structure should be there, common form of everything should be there. Then only they can able to compare understandable, relevant and reliable. So see now decision makers, whatever decision they need to take, it should be understandable. Understandable in the sense means the report should be understandable and simple term, so that they can make the decision. Decision should be useful. Whatever decision the decision maker take, or the decision should be useful, and it should be relevant, comparable and reliable. So reliability is segregated in three parts: verifiability, faithfulness and neutrality. Neutrality means it should be, partiality should not be there, it should be neutral, crystal clear. Verifiability, faithfulness, it should be proper what it should be. Then comes the relevance. Relevance means it is divided into two parts. The first is a timeliness. Within the time frame it should be presented, relevant, it should be relevant, the feedback and the dedicative value it should be having. Then comes the comparability. I've already explained you what is all about. Now you can see the objectives of accounting. In this slide we will be completing objectives of accounting, the main role of accounting, and the inclusions of services recorded by the accountants to the society. We will see here the three parts: objectives of accounting, role of accounting and the inclusions of services recorded by the accountants to the society. Now without wasting our time, we will see the objectives of accounting. So what are the objectives of accounting? Accounting's objective is to keep the systematic record of business. First one is that there are four objectives. Okay children, there are four objectives. The first is to keep systematic records of the business. To keep systematic records of the business. Second is to ascertain the financial results, that is profit or loss of the respective firm during a specific year. Okay. First is to keep the systematic record of business. Second comes to ascertain the financial result. What is the result? That is profit or loss during a specific academic year or specific particular year, financial year. Okay, you can say. Third comes the to show the financial status of a firm by preparing a position statement, that is by preparing the statement on a particular date. It will show the financial status of a respective firm. The last objective comes is to communicate what is the information, to communicate the accounting information to its users. Okay. So first objective is to systematic record, to keep the systematic records of the business. Second comes to ascertain the financial results, that is profit or loss of a firm during a particular year, that is the financial year. Third comes to show the financial status of the firm by preparing a statement on a specific date. The last comes is to communicate this information, that is the communicate accounting information to its users. So next comes the role of accounting. So what the role of accounting is? An accountant, what he will do? An accountant with his education, training, analytical mind and experience, he should be best qualified to provide. So what they provide? Multiple services to the end growing society, So see here, role of accounting means what is the role of an accountant? Okay, an accountant with his education, training, so whatever he has studied in his school and all, then analytical mind, the practical exposure and the experience are the best qualifications for him to provide and come in a multiple need-based service to the end growing society. So the accountants of today can do this full justice not only to matters relating to taxation, costing and management and all. They can also do, and they can act in the fields relating to the financial policies too. Financial policies, Even they can act for the economic principles. So a role of accountant is a pivotal role, or you can say it's a major and important role in giving the report or in submitting the report to the end user, that is to the users. An accountant with his, I will repeat once again, an accountant with his education, training, analytical mind and the exposure are the best qualification for him to provide multiple need-based service to the end growing society. So the accountants of today can do the full justice not only to matters relating to the taxation. Previously it was only related to the taxation, cost accounting, management accounting, then financial layout. Now it can further move towards the procedures, company legislation, and also it can move towards in the fields related to financial policies, budgetary policies, and even they can move towards the economic principles. So we will see the inclusions of the services recorded by the accountants to the society. Okay, they will record, see the first is to maintain the books of accounts, that is the major important point of them. So first is the to maintain the books of accounts in a systematic manner. Second comes the they can act as a statutory auditor. They can act as a statutory auditor. Third comes the they can also act as an internal auditor. Internal auditor. Then to act as a taxation advisor. Taxation advisor. Next comes the financial advisor. They can even act as a financial advisor. And the last, they can act as a management information system consultant. Management information system consultant. Okay, we'll repeat once again the inclusions of the services recorded by the accountants to the society. First is to maintain the books of accounts in a systematic manner. Second is to act as a statutory auditor. Statutory auditor. Third comes to act as an internal auditor. Act as an internal auditor. Next comes is to act as a taxation advisor. Taxation advisor. The next to act as a financial advisor. And the last is to act as a management information system consultant. Okay, so in this slide we have seen the objectives of accounting, the role of an accountant, as well as the inclusions of the services recorded by the accountants to the society. So objectives, there are in a sum up objectives, there are 4 objectives. The role of an accountant can not only and they can move towards the extent from financial policies to they can move towards the fields also. They can act as a financial policies, even economic principles and all. Then comes the inclusions. I've seen the maintain the books of accounts. Then comes the statutory auditor. They can act as a statutory auditor, internal auditor. Then taxation advisor, financial advisor, and the management information system consultant. Okay. The last slide will be of the basic terms in accounting. Basic terms in accounting. So in this slide, we will be seeing basic terms in accounting. So what are the basic terms? You can see here there are 20 terms. That is 20 terminologies given in accounting. In this chapter, there are 20 terms, basic terms, 20 basic terms. We will be seeing one by one. First, see here, first one is the entity. First one is the entity. Now, what is an entity? It means a thing that has a definite individual existence. Entity means a thing that has a definite individual existence. Second comes the transaction. So what are transactions? Transaction is nothing but an event. So you can say an event. An event involving some value between 2 or more entities. It should be minimum 2, right? Entity. It should be minimum 2 organizations. The transaction should be seller and buyer. So 2 of them minimum should be there. So 2 or more entities. Transaction is nothing but an event. Keep it clear. Students, just keep it clear. Transaction means an event involving some value between 2 or more entities. Assets. What are assets? Assets is nothing but anything which is in the possession, you can say, or is the property of a business enterprise, including the amount which is due to it from others, is called the asset. Understood? I will just repeat once again. Assets. What is assets? Assets are arts. Assets means assets which is in possession or is the property of a business enterprises, including the amount due to it from others. So others should pay him the respective, that is the A company and B company is there for an example. So B company should pay to the A company. We are only seeing now for the A company. So for A company it's the assets. As A company is having something, he is giving them in loan to B company. So B company needs to pay to the A company. So A company assets is there. Why? Because B company should pay that as a loan to A company. So thus the assets can be classified or may be classified as fixed assets and current assets. I hope you know what is fixed assets. You can see in your textbook itself they have been given a diagrammatic manner, fixed assets and current assets. Next comes the liabilities. The next comes the liabilities. Liabilities means it refers to any amount which the business enterprises owes to outsiders, excepting the amount owed to proprietors. Proprietors means who proprietors? Self-proprietor. See here, liabilities. So what is liability? Liability means liable. We are liable to pay. So A company is liable to pay to B company. It refers to the amount which the business enterprises, for example, A company is liable to pay to an outsider, or you can say the next company or some other person. So that is his liability. Okay. Then the liabilities can also be segregated in two parts: long-term liabilities and current liabilities. Long-term liabilities and current liabilities. Okay. Now see the next one is capital. Capital means the amount which is invested in an enterprise in the form of money or assets by its owner is known as a capital. So what is a capital? An initial investment, right? What is capital? Capital is an initial investment. So the amount invested in an enterprise in a form of money or assets by its owner is known as a capital. Next comes the sales. So what are sales? Sales means sales are the total revenues from goods or services sold or provided to customers. It may be cash sales, it may be credit sales. There are two types of sales, right? Cash sales and credit sales. So sales are the total revenues from goods and or services sold or provided to customers. It may be cash sales or credit sales. Next comes the revenue. What is revenue now? Revenue means an amount which business earned or received. Revenue means his income, which the amount which a business is earned or received. Revenue in accounting terms means the income of a recurring nature from any source. Income of a recurring means day-to-day daily basis, recurring nature from any source. Next comes the expenses. Expense. What is expense? You say expense means any cost which is incurred by a business in the process of you can say earning revenue are known as expenses. Expenses is nothing but any expense or any cost which is incurred by a specific business in the process of earning revenue. Okay, next comes the expenditure. So what is expenditure? Expenditure is divided into two types: revenue expenditure, capital expenditure. Expenditure is divided into two types: revenue expenditure and capital expenditure. The first, you can see what is expenditure. The first is spending money or incurring liability for some benefits, service or property received is called an expenditure. I would repeat once again. Spending money. What is an expenditure? Spending money. Spending money or incurring liability for some benefits. Why we incur liability? Naturally, it will be for some benefits, right? For some benefits or for some service or for some property received is called a expenditure. That's why we incur a liability to get some profit. So it is divided into two parts: revenue expenditure and capital expenditure. The next comes the profit. What is profit now? Profit means the excess of revenue of a specific period over its related expenses. So So what is profit? Profit means whatever you made an investment, whatever expenses you made, comparing the expenses, whatever revenue you have received now, we will just minus and what answer is got. If it's excess revenue, it will be profit during the accounting year. It's called a profit. So you can say the excess of revenue of a period over its related expenses during the accounting year is called a profit. Next is gain. So what is gain now? Gain is a monetary benefit, profits or advantages resulting from any event or transaction which are incidental to the business. Now see here, what is gain? Gain means it is a monetary benefit. Profit or advantages resulting from events or transactions which are incidental to the business. And what is loss now? Loss means in accounting the term has two different meanings. Loss has two different meanings. The first is the result of the business for a specific financial year when total expense exceed the total income. That is normal. You all know when expense is more and income is less. That means excess is what? Expense, not the income. Expense is expense. Excess is expense. So loss will be this. In accounting there are two different meanings. This is the first. Total expense will be more than the total revenue. Second will be some facts or activities against which the firm receives no benefit. Some facts or activities. Some facts means some information or some activities which the firm had did. But for that he was supposed to receive something, but he didn't receive at the last. So that is also a loss for the firm or a company. So that is also loss. Then discount. Discount means discount is the deduction in the price of the goods sold. So whatever the sales price is there, we will deduct the discount. Okay, so that is called the discount. Discount is nothing but deduction in the price of the goods sold. It is of two types: trade discount and cash discount. Cash discount and trade discount. Next comes the voucher. So what is voucher? Voucher is nothing but a documentary evidence, that is a documentary proof in support of a transaction. Documentary evidence in support of a transaction is known as a voucher. Next comes the goods. What is goods now? Goods means any product, buying and selling. Okay, it refers to the products in which the business unit is dealing. It refers to the products, which products in which a business is dealing with. That is in terms of which it is buying and selling or producing and selling. That is manufacturing and selling or buying and selling. Okay, then comes the drawings. Drawings is the withdrawal of money and goods or goods by the owner from the business for personal use is called as drawings. Drawings, you understood what is drawings? Drawings means, for an example, a company is there. A company has an account. From that A company, he has made an investment of 8 lakhs. Let's say 8 lakhs he has made an investment. That is his personal investment. So capital will be 8 lakhs. Now some urgency is there. He need to withdraw some money for his purpose. Not for the company purpose. For his purpose, he need to withdraw some money from the company. So what he will do? He will withdraw for the name he will give as drawings. That means he is withdrawing the money for his use. Okay, not for the company. Okay, for his personal use he is withdrawing the money. So 8 lakhs was the capital initial investment. It's called capital. Let's deduct the drawings. That is 3 lakhs if he is taking out. That is he is withdrawing the money. So 8 minus 3 will be the 5 lakhs. So 5 lakhs will be the last answer. So withdrawal of money and goods or withdrawal of money or goods by the owner from the business for its personal use is known as drawings. Next comes the purchasers. So now what is the purchasers? As the name itself suggests, what is purchasers, children? Purchasers means purchases are the total amount of goods procured by a business on a credit or a cash basis, either for the use or for the sale. Understood? Purchases are a total amount of goods procured by the business on credit basis or cash basis they are procured for either for the use of themselves or for sale purpose is called a purchase. Stock. What is stock? Stock means a measure of something on hand. A measure of something on hand like be it goods, spares, other items in a business. Then comes the debtors. Who are the debtors now? Debtors are the persons and other entities, or you can say or other entities who owe to an enterprise an amount for buying the goods and services on credit basis. Understood? Just revise once again. See here. Listen to me carefully. Debtors means who debtors? Debtors are the one, they are the one who they are persons and other entities or other entities who owe to an enterprise an amount, who owe an amount to an enterprise for buying the goods and services on credit basis. For buying the goods and services on credit basis. Then creditors. Who are the creditors? They are the persons and other entities or other entities who have to be paid by an enterprise. Who have to be paid by an enterprise an amount for providing the enterprise goods and services on credit basis. Both are for credit. Debtors and creditors. Debtors means they owe to an enterprise an amount. Here an enterprise should be providing them or should be paying them an amount. That's called creditors. When it is owing, it will be debtors. When it is being paid or paying, it will be creditors. Now here we have seen 20 terms of accounting. Entity, transaction, assets, liabilities, capital, sales, revenues, expenses, expenditure, profit, gain, loss, discount, voucher, goods, drawings, purchases, stock, debtors and creditors. So this is the entire first chapter. You should able to understand. It's a quick recall. I would be happy if you are able to read, understand and listen to each and everything which I have been conveying you. It would be more than enough for you to get a good marks from your exam. That is your textbook you should revise. Then the video which is being published here, the first chapter, Introduction to Accounting. This also you need to revise here. And the main notes which you maybe having from the college. These three is more than enough to get a good score. Thank you. See you on the next class with the next chapter of accountancy. I hope you are able to understand, read and making it very clear to get the not only to score good marks but also to use the accountancy concepts on a day-to-day basis. Thank you.